We at Radio Higher Ed are pleased to present this podcast in collaboration with the Postsecondary National Policy Institute, known as PNPI. PNPI serves as the leading source of professional development for congressional staff working on higher education issues. This podcast is a primer on federal student loan servicing. Our guest, Ben Miller, is the Senior Director of Postsecondary Education with the Center for American Progress, also known as CAP. Ben's team at CAP conducts research and analysis in areas related to post-secondary education, equity, accountability, quality, and data. Welcome, Ben. Thanks so much for being with us today.
Thanks so much for having me.
With November fast approaching, millions of recent college graduates are about to see their student loans enter into repayment. We'd like you to help us understand how loan servicers will help borrowers manage the transition and how loan servicers will help student borrowers manage the repayment of their loans. Our first question is simple. What is federal student loan servicing?
Basically, the best way to think about student loan servicing is these are the companies that, when you enter repayment, are going to be the ones you work with to pay down your debt. They're the ones who take your payments. They can help you change your payment plans. They can help you get on income-based repayment if that's something you're interested in. If you're struggling, they can help you temporarily pause your payments, etc. It's sort of like if you were to have an account with a bank, they're the people you pick up on the phone to talk to when you have a problem. The thing that makes this different is just that, unlike, say, with a bank where you get a checking account with a bank and then you call that bank when you have a problem, here you get your loan from the federal government, but you call one of these private companies when you have an issue with your student loan.
What role does the U.S. Department of Education have in federal student loan servicing?
Basically, the federal government is the bank here. It's the one that originates the loan, sends the funds out to the school, which is how you get your student loan, and ultimately it's the one that you have to pay back the money to. But the federal government doesn't actually handle the act of collecting payments itself. Rather, what it does is it contracts with 9 different private companies to do that work for it. So when you hear someone talk about their student loan servicer, what you're really talking about is a private contractor used by the U.S. Department of Education for you to repay your loans to.
So who are the current federal student loan servicers under this direct loan program, and how are they selected?
So right now we have 9 different companies that act as student loan servicers. There's 4 that service the majority of the volume, and they're called Title IV Additional Servicers, or TIVAs. The 4 main servicers are FedLoan, which is out of Pennsylvania, Great Lakes, which is out of Wisconsin, Nelnet, which is out of Nebraska, and Navient, which is also in Pennsylvania. One thing that's important to understand about Navient is this used to be part of Sallie Mae, but has since split in 2, and so isn't part of that company now. The 4 main servicers were selected through a competitive contract process during the Great Recession. Basically, what happened was when the economic crisis hit, a bunch of private banks that had been making federal loans were having trouble getting enough money to make new loans. So they worked out an agreement with Congress to create legislation that would allow banks to sell loans to the Department of Education. When this happened, the Department of Education realized it was going to need a lot of servicers to handle all these new loans it was taking over. So it started this contracting process and basically decided to hire these 4 companies. Then when the Department of Education took over the entirety of the federal loan portfolio in 2010, it started using these same 4 companies to handle all of the new student loan volume. Separate from that, though, we have 5 other companies that are called not-for-profit servicers. And these ones were selected in a little bit of a different manner. Basically, when Congress decided to end the bank-based guaranteed student loan program, it recognized that there were some nonprofit organizations that some members felt were important to keep in the federal aid program in one form or another. So what Congress said in that 2010 bill was that certain companies that were nonprofit and had been operating for a set amount of time had to be guaranteed at least 100,000 borrower accounts when the Department of Education created this new servicing system. So today we've got about 5 left that met those criteria. And those are Cornerstone, HESC, Granite State, OSLA, and Mohila. And so basically to sum that up more quickly, we essentially have 9 student loan servicers, 4 of which were selected through a competitive contract process, 5 of which were guaranteed some degree of participation through congressional legislation.
Can you just outline then their current roles and responsibilities in terms of regular in-school and repayment servicing and pre-default servicing, and tell us a little bit about what that all means?
The first thing that happens is when a student takes a loan out, the Department of Education is going to assign a servicer to handle it. So when someone someone's in school, the servicer doesn't really have a ton to do. They'll probably send the student a letter sort of saying, welcome, I'm your student loan servicer. If you need anything, contact me, etc. But they don't have to do much else because one of the rules in the federal student loan program is that you don't have to make payments on your loan while you're enrolled in school. So it's not really until someone either drops out or completes college that a servicer really gets involved. And when that happens, a servicer is going to start doing things like saying, hey, I just saw you just left school. Just so you know, in 6 months, you're going to have to start paying that loan back because students get this grace period. So they don't have to start paying, the instant they drop out. So they'll start with some reminder notes saying, hey, your payment is 6 months away. It's 3 months away. We're here if you have questions, etc. And then once someone enters repayment, they're in charge of doing things like sending monthly statements saying when your payment's due. If you have a question and say, I want to change my repayment plan, they're the ones who you call to deal with that. If you're having trouble making a payment, you can call them and say, hey, I need help. What can I do? And they can give you options like pausing your payments temporarily, switching to a payment plan where you might pay less each month, things like that. And then basically, if you start struggling and not paying your loan, what they'll start doing is being more proactive in reaching out to you. So they'll start sending you more messages, either via email or snail mail saying, hey, you're delinquent on your loan. If you keep doing this, there are consequences. You should really call us and try to pay. They'll start calling the borrower on the phone, things like that. And really, those are sort of the key tools. When I talk to servicers, the thing that they always stress is that their main goal is to try to get the borrower on the phone if the borrower is struggling. So any sort of pre-default assistance is going to look like a lot of attempts to contact the borrower through various forms of communication. I don't know that many of them are doing much in the way of text messaging yet, but I think they're all probably going to try going that route. But for sure, outgoing phone calls, outgoing emails, outgoing snail mail, sort of whatever they can do to get the borrower to call in and get on the phone. Because once the borrower's on the phone, then the servicer can work out some way to help them get back into good standing on their loan.
And then pre-default, that would be to help the student not go into default. And that's all the communication that you just outlined?
Yeah, that's right. So basically the rules of the federal student loan program say that you go into default on a loan once you haven't paid on it for 270 days. So essentially, as you start ticking toward that 270 mark, they're going to start doing more and more outreach to you. So, at first it might be that you only hear from your servicer once a month when they just say, hey, just a reminder, your payment's due this month. Here's the amount you owe. At 90 days, that might start becoming weekly conversations. By the point you get to, 250, 260, really close to default, they may be calling every day or a couple times a day, depending upon what the rules allow them to do. So essentially, the tools don't differ a lot. It's more that the frequency of outreach and then probably the training level of the staff on the other end of the line are probably higher, just because it takes a lot more work to fix a borrower who is, 200 plus days delinquent than it does someone who's 2 days late and just had a quick question.
You spoke earlier about the criterias that were used and the distinctions in terms of contracting with the loan servicers. Is there anything else that you think we need to know about how the Department of Education assigns those direct loans to servicers?
So in general, the main rule that the Department of Education tries to follow is that borrowers should only have one servicer. So whatever servicer you have for your first loan is the one that should be getting all of your subsequent loans. So in general, you shouldn't find yourself in a situation where you've got 4 different servicers or something like that, because the department's seen that having people split their payments that way creates a lot of confusion. The other thing is there are ways you can change your servicer. So just because that's who you start with doesn't mean that's who you have to stay with. In general, there's basically 2 main ways that someone changes their servicer. One is they create a consolidation loan. Basically what this is let's say you've got 4 different loans with 4 different interest rates. When you consolidate, you end up with one loan that has an interest rate equal to the weighted average of what the other loans had. So when you do that, you have the opportunity to select a new servicer if you'd like. One little thing about that that's worth pointing out is currently only the big 4 servicers can accept consolidation loans. There's currently a big push from Congress to have the Department of Education allow all 9 servicers get those consolidation loans. But right now, if you consolidate, you're only going to one of the big 4. And the second way people might end up switching is if they rehabilitate a loan. So this is basically when a loan defaults, borrowers basically get a one-time get out of jail free opportunity where if they make 9 agreed to payments in a 10-month period, they can rehabilitate their loan, which means it goes current again. The record of default is removed from their credit report, which matters if you're trying to get a job or get an apartment or something like that. And when you do that, you can select a new servicer. In general, the initial assignment is random, so you could end up with any one of the 9 just by chance. months. But after that, there are a couple ways you can switch around if you'd like.
What performance metrics does the Department of Education use to evaluate the direct loan servicers, and have the metrics proven effective or been well received?
The performance metrics are really at this point an ongoing development where the Department of Education keeps tweaking them, partially due to some changes required by Congress that are making everything more complicated. So I'll talk briefly about sort of how they work and then sort of where they're struggling a little bit. Basically, all servicers are judged on 5 main measures. The first is the percent of borrowers in repayment who are current, which is defined as being no more than 5 days delinquent on their loan. The second is the percent of borrowers who are medium to late stage delinquent, which would be being between 91 and 270 days delinquent. And the third is basically the percent of borrowers in repayment who have defaulted but not yet gone to a collection agency. And so those are people who are between 271 and 360 days delinquent. In addition to those 3 measures, the department also conducts a survey of borrowers to see what they think of their servicer, and a survey of personnel in the Office of Federal Student Aid to see what they think of the servicers. And so basically what it does is it takes each of those metrics and weights them by a certain amount and judges servicers against each other based upon how they do there. Now, this is getting more and more complicated over time because it used to be that what the Department of Education did was say, we're going to judge the 4 big servicers against themselves, and separately we'll judge the 5 nonprofit servicers against themselves. And to do that, what it said was basically the 4 big servicers will each get a share of 75% of the loan volume, and the 5 smaller servicers will each get a share of 25% of the loan volume. So it was able to sort of keep things separate and run basically 2 different competitions. Congress didn't like this, and last year it said that instead of running these 2 separate competitions, the Department of Education had to run one competition with common rules and measures for everybody. So on the one hand, this seems like it's a lot fairer. Everybody's being judged the same way, everybody's equal, etc. But there's a complication, and that is that the 4 main servicers have continued to get new loans over time. Since they came on board in 2008, 2009, they've continued to get brand new loans. The main nonprofit servicers really only got loans distributed once, sort of in about 2011, 2012 or so, and hadn't been getting new loans. And that matters because when you go and judge them on things like the percent of borrowers who are current, one of the things you see in the nonprofit servicer portfolio is that a lot of borrowers who are not current had defaulted years ago, and so they're not in the pool anymore. So in general, the pool of debts held by the nonprofit servicers looks a little bit better than those held by the big servicers. It doesn't necessarily mean that they're doing a better or worse job. It's just that the loans are older, so it's not really an apples to apples comparison. In an attempt to deal with this issue, the Department of Education is now taking the 3 main numerical metrics, which are like the percent current, percent in medium term delinquency, and the percent severely delinquent / in default, and breaking those down into 5 different categories of borrowers. They're now judging separately the performance of servicers on those 3 measures based upon students who graduated from their program more than 3 years ago, students who graduated from their program less than 3 years ago, students who dropped out from their program more than 3 years ago, and students who dropped out from their program less than 3 years ago, and students who have what's basically a parent plus loan or a consolidation loan. So you've basically got 3 measures broken down by 5 different categories now, plus the other 2, the borrower survey and the federal survey, that aren't broken down. All of that is a very long-winded way to say that what used to be a relatively straightforward set of calculations now has a ton of different complexities in it, as the department has struggled with how to fairly judge 2 groups of servicers that have radically different loan portfolios. And so one of the things we see is that when the department went to this change, the big 4 servicers all saw the amount of loans they were getting plummet. Essentially, how you do on these measures influences the percent of new loans you get. So it used to be that FedLoan got about 17% of all new loan volume because it was competing with 3 other servicers to get some share of 3/4 of the volume. Under this new system where everyone competes against everyone else, they're only getting 4% of the volume. So that's like a massive drop for them. On the positive side, for other servicers, places like Mohila, which is a Missouri-based nonprofit servicer, they only used to get about 6% of the volume, and now they're getting 16%. So essentially, this change has been very good for the nonprofit servicers and pretty bad for the big servicers. And so I think the issue here going forward is figuring out what is the fairest way to judge these two groups of servicers so that you're really giving credit for good servicing results and not just sort of other criteria like the age of the loans. The other thing that's really being discussed here is that nowhere in this is there actually consideration for other other either rewards or sanctions for other things related to servicing. So for example, none of the measures I talked about deal with what happens if a servicer consistently gives someone incorrect information, or what happens if a servicer consistently puts borrowers on the wrong repayment plan or fails to process payments correctly, or other things like that end up going wrong. None of these performance measures sort of contemplate taking current existing volume away from servicers. It's all about new volume. So I think that's sort of the other issue that's under discussion right now is, does there need to be some sort of situation where if a servicer is doing a really poor job, there's a way not just to limit how many new loans they get, but also do something about the loans they have now.
Is that volume based on the number of students, or it's based on the amount that the students are borrowing?
It's a number of new students.
So how do the direct loan servicers and the financial aid departments at institutions of higher education, how do they interact or work together?
So my sense is that the interaction is not super high. In fact, you actually have this sort of funny situation where a lot of institutions of higher education, especially ones that have high percentages of students defaulting on their loans, actually end up contracting with third-party companies to come in and help on their loans because they need someone who will do even more outreach to borrowers to keep too many of them from defaulting. My sense is there's a little bit of back and forth in the sense of if a school is concerned about how a servicer is doing, they can call the servicer and ask and things like that, but it's not a particularly regular dialogue or something that has a lot of interaction with it. What's interesting is it actually used to be that schools were surveyed as well as a performance measure for servicers, and I believe in 2014 the Department of Education decided to take that out. So there's not actually really a formal role right now for schools to give feedback to servicers in a way that might affect how many loans they get in the future.
Is there any pattern around it? Do the servicers typically service students in a particular geographic area, or that is totally irrelevant?
That's totally irrelevant. So,
okay.
When a loan is distributed, the Department of Education randomly assigns it to a servicer with the idea that, you get your percentage share. So until about sometime next year, Mohila is going to be the most likely servicer to get any given new loan because it's going to get 16% of all new loans. But there's a bunch of others that are at like 14% or 12%. So it's almost close to an equal distribution in most cases. Just because you are a borrower in Missouri doesn't mean you're in any way guaranteed to get Mohila. You could get OSLA, which is in Oklahoma. You could get Fed Loan in Pennsylvania. It could really be anybody.
That's an irrelevant.
That was one of the discussions that happened when the nonprofits came online, because a lot of these nonprofits used to be very sort of local operators. They were only really serving their home state. So they had asked for the ability to just serve borrowers in their state at first. And I think the decision was basically that it didn't make as much sense to do that, whereas you'd have sort of more competitive dynamics by spreading all the loans around. I think there's arguments to be made for both sides of it, but I think given that the goal here is to have servicing done at a relatively economical scale, it probably didn't make a ton of sense to have it be too geographically specialized.
Given all that you've just taught us, what are the 3 things you'd like students and families to take away from this conversation? What is it they absolutely need to know about loan servicing, and why is that so important?
First, your student loan servicer has a lot of tools to help you if you're struggling. I think one of the mistakes people make is they assume that if they call their servicer, the servicer is just going to say to them, hey, you have to pay us as much as possible right now. And that's not how it works. When you look at how servicers are judged for performance, the thing that matters most to them is keeping a borrower current. And that means they have a much stronger incentive to use tools that help borrowers without demanding they pay as much. So that means that if you're struggling, a servicer can say to you, well, what's your income like? Maybe you might pay less if you're paying based upon your income. Or they can offer you the ability to pause your payments for a little while. If you're a veteran or a service member, you might be able to lower your interest rate. A lot of times people feel like, well, this company is calling me and they're hounding me and I'm just really afraid they're just going to make me pay. That's really not what they are going to do. They have tools to help you do other things besides pay as much as possible right away. The second thing is that the company calling you is probably a contractor from the Department of Education, but you should be sure. One of the challenges you have right now is all of these servicers still use their original brands along with the Department of Education logo. So one of the things you hear sometimes is some confusion about, oh, I thought my loan was from the Department of Education, but then I'm getting this call from Navient, and did they sell my loan? What is this, etc. And it creates a little bit of confusion for borrowers. So I think it's really important to make sure you know who your servicer is and to understand that they're a contractor from the government. It's not that your loan got sold. At the same time, though, you really want to make sure, though, that the person calling you is your servicer and is on the up and up, because one of the other problems we see here is that there's a lot of these third-party debt relief companies out there that will advertise things like Obama loan forgiveness and stuff like that, which will then basically charge you fees in order to do things that should be free. Your servicer is not going to charge you money to apply for income-based repayment. They're not going to charge you money to defer or temporarily pause your loan payments or anything like that. That is all free of charge to you and should not cost you anything. And the challenge you get is there's a lot of companies out there that will try to sort of sell you something that you shouldn't be paying for. The third thing I would say is it is really important to not default on your student loan. If you default on your student loan, the consequences are pretty severe. Your credit can be impacted for several years. It can be referred to a collections agency, which then can do things like garnish your wages, seize your tax refund. If you're older and on Social Security, they can take some of that as well. You really don't want to default on your loans. And the nice thing is there are lots of tools to help you avoid that. So, if you're having trouble paying your loans because your income's not high enough, there's almost certainly going to be a payment plan out there that will probably let you pay less and offer some path to loan forgiveness. So, I think it's really important to understand that paying loans is scary. It's not pleasant. No one likes handing money over, but it is much better than defaulting. And there are ways to make it more manageable on a monthly basis. If you have a problem with your servicer, you do have means for seeking recourse. Essentially, the Consumer Financial Protection Bureau has a tool that allows you to report complaints about servicing and raise concerns. And the Department of Education as well has, I believe, recently launched a complaint tool. And these things matter because if you really are having trouble and are worried that you're not getting served well, providing a complaint creates something that servicers feel the need to respond to. We've seen this with other complaint systems used by the Consumer Financial Protection Bureau where it's a black eye for them. And so when that complaint comes in, they really do feel the need to respond to that. So, if you have a problem, you should say something and not just sort of sit on it.
And where do students go to complain if that's a justified issue there? Where would they go?
So the Department of Education has created a complaint system, which you can find at feedback.studentaid.ed.gov. And you can file a formal complaint both for yourself or for someone else, and that should get routed to the right people in the Department of Education.
So are there any other resources that you'd like to point our listeners to so that they can learn more about the topic?
The Department of Education posts data about how student loan servicers are doing on its website. If you look for the Federal Student Aid Data Center, you can read more about that if what you're really looking for is lots of spreadsheets and numbers and things like that. If you have student loans and you're trying to figure out what to do on them in particular, you can go to studentloans.gov, and that's where you can log in and do things like figure out your repayment options, consolidate your loan, apply for income-driven repayment, etc. That's right.
Well, Ben, I think this has been extremely, extremely useful to help me and our listeners understand more about how the student loan servicing process works. Thank you.
Sure, no problem.
On behalf of PNPI and Radio Higher Ed, we hope our listeners found this podcast has added to their understanding of loan servicing. We invite you all to join us for future professional development activities